Okay, welcome. My name is Kyle, and this is going to be an e-tutorial on how to solve problem E8-18 from the Pearson workbook. So what we have here, the petty cash fund had the following petty cash tickets, which are highlighted here. And what we need to do, assume the business had established a petty cash fund in the amount of 250 and that the amount of cash in the fund at the time of replenishment is $20. This business uses a perpetual inventory system, and we need to prepare the entry to replenish the fund on February 28th. We'll assume 2020. So what we need to do, or just prior to solving this problem, what I'm going to do is just briefly describe what a petty cash fund is. So we know that organizations keep money in the bank. This is a safe spot for it. They're not going to keep cash in pillowcases or just in office drawers because it would be subject to theft at that point if they did, or could easily get lost. So for safekeeping, they store money in the bank. And this is depicted just by this red box in the bank here. Now, what they do though is they sometimes establish a petty cash fund. That means they go and they withdraw money from the bank and they put it physically in a box. It could be a box or an envelope. And it's somewhere stored physically, and there's usually a petty cash custodian that's responsible for all of the expenditures out of this physical box. This petty cash fund is for low value purchases. So when an organization establishes a petty cash fund, and I know this isn't part of the problem, but they would be physically going to the bank and withdrawing money and putting that money physically into a petty cash box or an envelope or whatever. And that envelope would be stored in somebody's desk, the petty cash custodian's desk. So since they're going to a bank and they're withdrawing money from their bank account is increasing, but this petty cash account is increasing. So the journal entry to do that would be, well, petty cash is going to go up. That's just another cash account. And cash in the bank is going to go down. So they're going to debit petty cash and credit cash. In this case, what was it? They had a petty cash fund in the amount of 250. So the journal entry to do that is 250. Now I know this journal entry wasn't part of this problem. I do want to go through this background with you prior to solving this problem though. So this would have been the journal entry to establish cash. And you can see that that kind of makes sense, right? Because, well, cash in the bank is going down and cash in the petty cash fund is going up. And that's exactly what's happening in this journal entry. They physically went to the bank and they withdrew 250 and they put it in petty cash. And that's in an envelope or a box or somewhere, wherever the custodian keeps it, somewhere safe. So what happens after the petty cash fund is established is that expenditures come out of petty cash. So money goes out to pay for low value purchases. What goes in is some sort of ticket or receipt to keep track of the expenditures that came out of petty cash. But these here, the money going out of petty cash and the receipts or tickets going in, there's no journal entry happening for those because they're low value purchases. It's not really, they won't have a material impact on the financial statements, and it's inefficient to do a journal entry for every single transaction out of petty cash. So what happens is all of those tickets are collected and added together. And then once the petty cash needs to be replenished, a journal entry is needed. And that's when these expenses get recognized. So the amounts of each ticket are added together, and then a journal entry is done to replenish petty cash and recognize those expenditures in the general ledger. So that's the background. So to establish petty cash, go to the bank, take money out, and then expenditures come out of petty cash and tickets go in. And then when petty cash needs to be replenished, these transactions are recognized and money comes out of the bank again. So that petty cash again increases. So what do we have here? So the petty cash fund had the following petty cash tickets. So I'm reading the question, it had these tickets and these amounts here. So this is here, over here, describing this situation. Money went out of petty cash, tickets went in. The tickets tell us what general ledger accounts or what expense accounts need to be recognized when we do a journal entry. So I'm going to set myself up a journal entry template. Date. And I'm going to just make this a little bit cleaner. Okay. So this was what, February 28th? And the account here, the first account, it says toner for printer, $42. So somebody went to petty cash and they withdrew $42 for toner, and they gave a ticket that described that transaction, and that went into petty cash. This is like an office supply. So I'm going to debit office supplies because this is the expense account for $42. Next, what happened? Freight to deliver goods sold. So that's going to be a freight expense in the amount of $39. So somebody sold something, they made a sale, and they decided to pay freight expense out of petty cash. So $39 came out of petty cash, and what went into petty cash was just a receipt, a ticket describing why the petty cash fund decreased. And then it was freight on inventory purchased of $112. And remember, when we're paying freight for inventory that we're buying, that gets added to the cost of inventory. 112. Then there was a miscellaneous expense, $10, and postage expense of $25. So we know these are all going to be debited. At the time of replenishment, this fund had $20 in it. So if I were to look at this, and I'm going to just try my best here to show a chart. The target balance, or when the petty cash fund was established, it was $250. So $250. Now, the petty cash fund has $20 in it. So this is the value of petty cash. It was $250, but now it's only $20. That means it decreased by $230. But there's only receipts for $228. So petty cash fund, the custodian, made an error somewhere. They only collected receipts for $228, but they should have collected receipts for $230. So there's a clerical error in issuing this petty cash, or in administering this petty cash fund. So what happens then? Well, a $2 error wouldn't be considered material, so they recognize an expense for it, and they have this cash over or short account to recognize. And this cash over or short account can have either a debit balance or a credit balance. When it has a debit balance, it's basically a reflection of an expense. Remember, expenses have a normal debit balance. But when it has a credit balance, it's kind of like a revenue. So it can be either debit or credit balance, depending on whether or which side the custodian made an error in, whether they didn't collect enough receipts, or maybe they made a math error somewhere. So they want to know, and I maybe shouldn't have erase my petty cash fund. 250 is the target balance, and 20 is what's in there. So they want to replenish the fund by this amount, which means they're going to want to replenish it by $230. So they have to go to the bank to withdraw $230 to put that money back into their petty cash fund. So since they have to physically go to the bank and withdraw it, 230, they're going to be crediting their cash bank account by 230, and that goes back into petty cash to bring it to 250. So these transactions that happen over here don't get recognized into the GL until you replenish in petty cash. And when you're replenishing petty cash, you have to go to the bank to withdraw that money to put it into either the box or the envelope or wherever the custodian keeps it. So that is problem E8-18. I hope you found this tutorial useful. If you have any questions, feel free to reach out to me or to any of your instructors. Happy to help. But otherwise, my name is Kyle. Have a great day.